Dividend investing is popular with many kinds of investors. Historically, dividend investing has been most popular with the older investors, many of whom are looking for a reliable stream of income to fund their golden years. Best dividend stocks can pay a meaty dividend and grow it over time too. And with inflation-dodging investors, now may be a particularly good time for dividend stocks. Dividend-paying stocks tend to be more defensive and actually outperform growth stocks in periods of high inflation, high interest rates, and economic uncertainty. Investing for the long haul is fine, but sometimes you need a little help here and now. How can you best take advantage of dividend stocks? Top investors use many tricks to get the most out of them. In today's video, we're going to discuss the top 5 things to do and to avoid doing. In investing, it's often just as important to avoid doing unwise things as it is to actively do smart things. Let's go. Hello, and welcome to Project Dividend, where we help you navigate the journey of becoming a well-informed and knowledgeable investor, thereby fulfilling your potential. We begin with basics and transition you to becoming that well-informed investor. Along the way, we encourage you to interact with us through your questions and comments. We usually post a new video at least once a week, and we appreciate you watching. And if you've not done so before, please subscribe, like, and share this video. The content is not intended to be financial advice. Seek a duly licensed professional for your financial advice. Now that we have that out of the way, let's get started. All right, so let's jump right in. The number 1, finding a sustainable dividend. Finding a sustainable dividend is one of the surest ways to avoid loss, which is the number 1 and number 2 rule of legendary investor Warren Buffett. When it comes to dividend investing, one of the best ways to avoid loss is to look for a company that can sustain its payout even if business declines in the short term. Why is a sustainable dividend so vital to an investment? Because if investors think that a company has an unsustainable dividend, then if and when a dividend cut actually happens, the stock will almost assuredly get pummeled again as investors flee. Many large investors, such as investment funds, will reduce their positions or may be forced to sell entirely if the company cuts its dividend completely. One quick check on whether a dividend may be sustainable is to see what % of the company's profit goes to pay the dividend. Companies that pay less than 50% of their profit out as dividends are more likely to weather a downturn in the business without cutting. Still, some companies such as REITs can safely pay out more cash without much trouble. Investors can also check out stocks that are included in lists such as Dividend Aristocrats. We do have a video on Dividend Aristocrats. I'll put it down in the comments. Number 2, you want to reinvest those dividends. Getting a cash payout from your stocks is valuable, but if you spend that cash, you won't be able to take advantage of the compounding effect of reinvesting your dividends. Reinvesting your dividends can give your portfolio a needed boost and supercharge your investment gains. Since the 1930s, more than 40% of the returns of the S&P 500 can be attributed to dividend income. Dividend income tends to cushion the price volatility of stocks and therefore mitigate overall volatility in a portfolio. Most brokerages will reinvest your dividends automatically if you instruct them to do so, and they'll even buy fractional shares so you can put all that money to work immediately. Then when the next dividend is paid, you'll make even more money on your payout. At its best, you'll create a virtuous circle in which your wealth continues to compound with each and every quarterly payout. It is worth noting that dividends are taxable, even if you reinvest them. So dividend reinvestment may work best inside a tax advantage account, such as an IRA or 401k. Inside these accounts, you won't owe taxes immediately or maybe ever if you use the Roth versions. Number 3, avoid the highest yields. When you're looking at lists of the market's top yielding dividend stocks, It can be tempting to pick the ones with the highest dividends. After all, that would seem to be the quickest way to compound your money. But often those high yields are dangerous. They're a sign that the market does not trust a dividend's sustainability, and so the market pushes the stock price down to compensate. Buying the highest yields can be detrimental, as many times these high yields are transitory and may be made up of a one-time distribution that increases the yield temporarily. These types of securities tend to be extremely high in price volatility as well. So unless you're an expert at analyzing investments, it's best to avoid the market's highest yielding stock. If you buy the highest yields, you could quickly lose much more money than you'd ever earn. Number 4, you want to look for dividend growth. Dividend growth is far more important than dividend yield. Many investors get caught up in looking at a stock's current high yields and fail to consider how much a company can grow its payout over time. But a growing payout will help you mitigate the effects of rising costs on your portfolio. And that's crucial if you're investing for decades. And don't forget inflation. A good dividend portfolio should keep up with the average annual increase in the cost of goods. Investors can run a few checks on their company to see what its dividend growth might look like in the coming years. A dividend payout ratio, this is the ratio of dividends to total profits. The lower the figure, the more the company could raise its dividends safely. And then there's the dividend growth rate. This is how quickly the company has raised its dividend in the past. Higher growth may signal that a management is willing to pay shareholders more. Earnings growth rate. A company that continues to grow its earnings will have more capacity to grow its dividend. For example, a company that grows its earnings at 10% annually could potentially also grow a dividend sustainability at that rate. If a company can generate strong and sustainable free cash flow from operations, then there is a greater likelihood that the company will be able to grow its dividend and continue to deliver strong returns to shareholders over time. Number 5, buy and hold for the long term. If you're really looking to turn your portfolio into a dividend dynamo, then you're going to need to invest for the long term. That means finding a solid dividend payer and then sticking with it over time. That time element is absolutely crucial, but it's easy to get tripped up when bad news hits. Look at the experiences of Warren Buffett and his purchase of Coca-Cola stock at his holding company, Berkshire Hathaway. Berkshire Hathaway purchased 400 million shares of Coca-Cola for about $1.3 billion nearly 3 decades ago. The stock has risen, of course, and is worth about $25 billion as of June 2022. But check out what Berkshire earns in dividends. Coca-Cola pays about a 3% dividend yield today. Not especially high, but Berkshire's yield on its investment is enormous. Coke is due to pay out about $700 million this year to Berkshire. So the company's earning more than half of its original investment each year on dividends alone. And that's the power of dividend investing with a buy and hold mentality. Bottom line, all too often, many people think of dividend investing as the province of stodgy investors. But dividend investing can be one of the most stable and lucrative forms of investing. Use these 5 secrets to improve your dividend investing strategy, and remember to always think long term. And as is our custom here, we have 5 more dividend aristocrats coming up. Okay, so for the next 5, we have W.W. Granger. Ticker symbol is GWW. We have PPG Industries, ticker symbol PPG. We have Target, ticker symbol TGT. We have Abbott Labs, symbol ABT. And we have ABV, symbol ABBV. There it is. Well, that just about does it for this video. If you like the content that we're sharing, please subscribe if you haven't done so, like the video, and share the video. Until next time. Hey, Dividend! I've got my eye on you.